Welcome, everybody. Today, we are glad to welcome Marzena Rostek from the University of Wisconsin-Madison. Marzena will present a work with Yoon entitled Innovation in Decentralized Market. Well, I don't think I need to present Marzena. She has substantial contributions on micro theory, of course, on market design, and also on finance. Thanks a lot, Marzena, for being with us today. It's all our pleasure. Before to start, a few words to remind us the rule and procedures of the seminar. Marzena will make some breaks at some relevant moments, and during these breaks, you could unmute yourself and ask your question. You can also, if you have a very important question, ask your question directly to Marzena during the talk, even if there is no break. Please be aware that the video is recorded. So if you don't want to be in the video, it's no big deal. You can ask your questions through the chat window, and I will ask them directly to Marzena during the breaks. Last information, if you have a bad internet connection, you could download the slides from the seminar website. I will post the link in a few minutes through the chat window. Marzena, thanks again for being with us. It's all our pleasure to having you. So the screen is yours, so the seminar is yours now.
Thank you so much for having me in this very special seminar series. This work is joined with Yoon, who is now at UCL and will be on the market this year. She's completing her postdoc. The results I'll present are part of our longer-term project, which grew out of thinking about innovation in financial market design, in particular, innovation in market clearing technology and financial products, and how some of it is at odds with a couple of assumptions in the standard model of financial markets, namely the assumption that financial markets are perfectly competitive. That is, no individual trader has an impact on prices, and trading is centralized. Essentially, a single aggregation, a single market clearing applies to all traders and all assets. Well, we've known at least since the mid-1980s, when individual level data became available, that the presence of large institutional investors is significant in the financial industry in terms of trading volumes, ownership, as well as the ability to innovate and access information. Institutional investors routinely estimate their price impact. The price impact costs are of first order for incentives. They dominate all of the explicit trading costs, including commission fees, order processing fees, and brokerage fees. A bit more recently, the financial crisis has highlighted the extent to which markets are fragmented or decentralized. Essentially, all financial assets are traded in a variety of coexisting trading venues of various kinds, often for the same traders, often for the same assets. These venues clear independently, and typically assets listed in those venues do as well. So our goal in this project is to understand the potential for market fragmentation to create gains from trade, from innovation of new financial products. Think of synthetic products, and innovation in market clearing technology, which will become apparent as soon as we relax the assumption of centralized trading, but which intuitively would not even be well defined if trading were centralized. So more specifically, we ask the following questions. Can we identify decentralized market effects which have no centralized market counterparts, which motivate innovation? And when is innovation in fragmented markets actually efficient, given that it changes the market structure? It's underlying all of this is the following question. If it were feasible to centralize all the trading in financial markets, under what circumstances would such a market structure be efficient? All right, so our paper is part of a growing literature on decentralized trading, which has been particularly active in the past decade and a half, since the publication of Duffy, Garliano, and Peterson in 2005 in Econometrica. Mathematically speaking, this literature is based on graphs, random or fixed. So far, the literature has put forward a number of arguments in favor of or against market fragmentation, and will contribute a new argument to this discussion. The main characteristic of markets we would like to take seriously is that traders have price impact. In practice, dealing with strategic behavior or traders' price impact is often a primary motivation to set up an alternative venue or to introduce a new financial product. So the fact that traders are non-negligible in the market might matter for understanding innovation. All right. Ideally, we would like to write down a model which can directly nest the standard centralized market model for divisible assets with multi-unit demands based on the canonical uniform price double auction, and just like in the competitive model, which is based on the uniform price and multi-unit demands. And it's imperfectly competitive game theoretic counterpart games and in demand and supply functions. Now, as you can see, a lot is happening in this literature right now. Still, most of what we understand about equilibrium with large traders has been established in a variant of a quadratic Gaussian setting, which we'll also assume. So traders' objectives are quadratic, all random variables are jointly normally distributed. You'll see that this is not critical to the types of conclusions I'll emphasize. Right? So the description of preferences and assets is standard. Agents with a quasi-linear and quadratic in the quantity traded QI utility trade multiple divisible risky assets with a covariance matrix sigma. Traders derive utility from their post-trade allocation, which is the sum of trade QI and the initial units they hold. I'll call these endowments. Okay, so these initial units are traders' private information. I know how many units I hold. I do not know the positions of others, and they are independent across traders and assets. So fundamentally, gains from trade come from the need for diversification and risk sharing. These endowments are heterogeneous. Okay, so this is completely standard. The only assumption of the centralized market model we intend to relax is that trading is centralized. It is useful to consider for a moment what exactly the centralized market assumption entails. Okay, so let's try to think. What do we assume when we take an off-the-shelf model of centralized trading? The essence of centralized trading in the standard model is not centralized or decentralized implementation, but rather that a single market clearing applies to all traders and all assets. In particular, two assumptions are implicit in a centralized market assumption. One is that trader participation in the market is complete in the following sense. Each trader trades all assets with all other investors. So naturally, this assumption has been relaxed by the large literature on decentralized trading based on random graphs or fixed graphs or other models with limited participation. Now, there is at least one other assumption that is implicit in the centralized market assumption. So when trading is decentralized, we need to be explicit, we as modelers need to be explicit, or a market designer needs to be explicit, or a trading protocol needs to be explicit about the types of demand schedules allowed. Okay, so imagine I participate in markets in a market with two exchanges, each for one asset, let's say the same asset. Should the demand I'm submitting in one venue allow me to condition on the price in the other exchange? Right? So in other words, should I be submitting a fully contingent schedule, R2 to R2, with the quantity demanded of each asset being a function of the price vector? Or I should be submitting two uncontingent schedules, R to R, with the quantity of each asset being a function of the price of that asset alone. So it turns out that the standard equilibrium model of financial markets, based on which asset pricing is based, competitive or imperfectly competitive, assumes fully contingent schedules, which in practice represent cross-asset conditioning possibilities that exist in some, but not too many trading protocols. More typically, an order placed for an asset cannot be made contingent on prices of other assets. If allowed, such cross-asset conditioning applies to only a limited subset of assets. So we see cross-asset conditioning in markets for electricity, spectrum, emission permits, some markets for futures and options, a combination of rules called Reg NMS and unlisted trading privileges implemented in the US about 15 years ago. de facto induces contingent schedules in the US stock market. But we do not see analogous rules in markets for other asset classes or the stock market abroad outside of the US. Feasibility might provide one rationale why such cross-asset conditioning is not too prevalent. In fact, electronic trading platforms experiment with and innovate on such orders. Now, in this paper, we are going to show that if the market is suitably designed, contingent schedules are weakly suboptimal. Okay. So let's try to take a closer look at how cross-asset conditioning matters. I'll be working with the market with I traders and K assets described on the previous slide, defined by K exchanges, each for one asset, at least in the beginning of the talk. All traders participate in each venue, so the participation in the market is complete, it is symmetric. All traders trade all assets. So the effects established by the literature on incomplete participation do not kick in here. But now traders submit uncontingent schedules. So what is the significance of that? Well, the assumption of fully contingent schedules in the standard model requires that the demands and supplies of all traders for all assets should be aggregated jointly to even determine the vector of market clearing prices and trades. The assumption of fully contingent schedules in the standard model implies that all assets must clear simultaneously. So apart from the identification of decentralized market effects, which have no centralized market counterparts, the more specific objective of this paper is to understand the implications of independence in market clearing across venues or across trading protocols within trading platforms. Both can be accommodated by a notion of an exchange. That's really what an exchange captures in the model, independence in market clearing. The model can be scaled up. All right, so that's how the market is organized, but how does the market clear? Well, in each exchange, trade takes place the standard uniform price double auction. So traders submit price contingent demand and supply functions. So these schedules are still contingent on the prices of the asset traded within an exchange. The market clearing price is the price at which the aggregate net demand is zero. Individual quantities are given by the submitted schedules at the market clearing price. Right, and just like it is common in the literature, we'll be working with linear demands. So demands are linear functions of prices, or inverse demands are linear functions of quantities. And nothing I'll say relies on the presence of noise traders or not fully optimizing agents. Okay, I feel like this is a great moment to ask if there are any questions. I can certainly go on. Do you have any questions about this idea of cross-asset conditioning? I know that sometimes people wonder, well, even if I cannot condition my schedule in this round on the price of an asset traded in other venue, in the same round, nobody can prohibit me from conditioning on past prices, right? From any venue, as long as these prices are available. So does cross-asset conditioning really matter? Right? Most markets are dynamic, and presumably with frequent trading, these effects would become weaker. Well, the ability to condition on past prices allows traders to, whether schedules are contingent or uncontingent, the ability to condition on past prices allows traders to incorporate information about past shocks, at least partially. The ability to condition on simultaneously determined prices in a given round affects how the current round shocks impact my behavior. That's what this paper is about. These effects will be present in every round in a dynamic market. Now, there is this conjecture that if the frequency of trading is sufficiently large, these effects might go away. However, this conjecture is likely to be true only under very special conditions. So think about the following. In general, whether the effects of uncontingent trading are going to be significant in dynamic markets should depend on the relative frequency of shocks to information or traders' liquidity that renew gains from trade compared to the frequency of trading. Okay, so in particular, if shocks to information are as frequent as trading runs, these effects will be of first order in any given round, even with continuous trading. Okay, so that's what I wanted to emphasize. All right, I'm happy to stop at any time. So feel free to just jump in. Otherwise, I'll keep going. All right, so let's briefly review the standard centralized market model with large traders and its key properties, which we show do not hold in more general designs. Okay, so let's suppose there is a single exchange for all traders and all assets, and traders submit fully contingent schedules. Well, in markets in which traders submit price contingent schedules, it's useful to think of a player as trading against a residual market, represented by his residual supply function. This motivates a point-wise optimization problem. So point-wise optimization with respect to prices, which one can show is equivalent to optimization in demand functions. And in the point-wise problem, equilibrium can be characterized by two simple conditions. Optimization, taking as given a trader's residual market, essentially his price impact, and the requirement that the price impact should be correct. Right, so the first condition is simply the first order condition of a monopolist, except that it applies to all traders, right? We are working with a multilateral oligopoly model, if you will. With K assets, lambda is a K by K matrix. Its element KL represents the price change of asset L following a unilateral demand change for asset K. The inverse of price impact is a common measure of market liquidity, which gives a more direct interpretation. So I might use it sometimes. For the intuition, the more elastic my residual market, by definition, the smaller my price impact, the smaller the price concessions required when changing my demand, the more liquid my market. It's something to observe. If I knew my price impact, I could then compute my best response schedule, given that I know my marginal utility. But these price impacts are endogenous. They depend on how others bid. Okay, so the second equilibrium condition requires precisely that the price impact assumed by a trader in his point-wise optimization is correct. What does it mean? It matches the Jacobian of the residual inverse supply defined by aggregation of demands submitted by others. The traders J different than I. Okay, so this gives the following condition. The price impact of trader I is a harmonic mean of inverse demand slopes. The harmonic mean appears from aggregation in market models. And it turns out that when trading is centralized, the system of I, such harmonic mean conditions, can be solved in closed form. And the solution reveals a property that turns out to be important for understanding how centralized markets function. So here's the solution. Okay, so when trading is centralized, when all assets clear jointly, it turns out that the price impact of every trader is proportional to the fundamental covariance matrix, which also feeds in the Hessian of in the concavity of the utility function of each trader. This proportionality coefficient beta I can be characterized as a function of the primitives, in particular the number of traders, all traders, risk aversions. I didn't put it on the slide because the point here is that it's a scalar. Okay, so number one, where does price impact come from? Well, my price impact comes from the concavity of the payoff functions of my residual market. So just as in a competitive model, there is a link between concavity and behavior. But you can see how price impact modifies this link. And second, when trading is centralized, the link between price impact and covariance intuitively between incentives and risk is quite particular. It is linear, and this is going to matter. Okay, so with that, for the same traders and assets, let's now consider a multi-venue design. Okay, so think of an individual optimization problem of a trader in a decentralized market with k venues, each for one asset. His objective function is the same, and so is his information set, the privately known endowment vector. What changes is the choice variable. Now the demand for each asset is contingent on the price of that asset alone. Okay, so in this talk, I would like to focus on the questions that have to do with design and welfare. So let me just summarize how uncontingent demands affect the traders' incentives in a couple of minutes, and then move to design. Well, uncontingent schedules or independence in market clearing has two main effects on the first order condition. First, the cross-asset price impact becomes zero by the definition of uncontingent schedules, right? When I increase my demand for asset K, I no longer expect the prices of other assets to change. So in contrast to centralized trading, where price impacts are proportional to covariance matrices, now price impacts are diagonal. Okay, so even though the cross-asset price impact is eliminated, the equilibrium outcome, prices and allocations are not independent across exchanges, in which case the market would operate de facto as a collection of independent venues. This is because this is as long as the utility Hessian is not separable, right? In which case the sigma k elements would be equal to zero, and the trade of other assets would not affect my marginal utility for asset K. In this case, the asset payoffs will be independent, which brings me to the second difference with respect to contingent demands. Okay, so now, with uncontingent demands, my demand for asset K can no longer condition on the actual trades of other assets, but it still depends on expected trades. Okay, well, actually, why does it? My endowments are independent across assets, but my valuation is not. Again, as long as the utility Hessian is not separable. All right, so because of these cross assets, because of the cross asset inference, the equilibrium is not exposed, and is characterized by quite a complex fixed point across assets and traders between price impacts and conditional expectations. And it might seem that this additional fixed point makes the problem intractable. However, we show that the equilibrium fixed point in demand schedules is equivalent to a fixed point in price impact matrices once the problem is written in matrix form. Okay, so this not only makes the problem fantastically tractable, but it also allows us to develop the comparative analysis of equilibrium and welfare in terms of the endogenous price impact matrix of a single trader itself, which I have yet to characterize, right? So far I've only mentioned that the cross-asset price impact is eliminated. It turns out that the price impacts within venues also change relative to their contingent market counterparts. This is the last bit I need to mention to return to the welfare question. So let me just say the following. The reason why price impact is different is cross-asset inference. Now, price impacts depend on the inference, on the distribution of private endowments, private holdings of the initial units traders have. And in general, our economic intuition tells us that these inference effects will depend on in a complex way on the complementaries and substitutabilities in traders' payoffs, which can be arbitrary. The only restriction on the sigma matrix is that it's a covariance matrix, right? However, we can show the following. If assets are symmetrically correlated, so if assets are symmetric payoff complements or substitutes, the uncontingent trading always increases price impacts within venues. More generally, it may increase or lower price impacts. All right. Why might we expect markets with multiple trading venues, which clear independently, to be more efficient than a single exchange which clears all assets jointly? Okay, this is really the main question, the main motivating question for this paper. Well, in markets with large traders, the first Wilfer theorem does not apply, but we knew this much coming in. Still, why might independent market clearing be more efficient? Well, if the market were competitive, the contingent design would be efficient irrespective of market characteristics. It would eliminate the information loss across assets. So the key is that independence in market clearing can lower the trader's price impact and overcome the welfare loss due to information loss. Okay, so that's where the possibility comes from. But still, is the contingent design going to be generally inefficient in markets with large traders? And what exactly can we say, given that the comparative statics on the previous slide I reported briefly suggests that the price impact within venues may or may not decrease with independent clearing. Moreover, the zero cross-asset price impact may or may not be conducive to efficiency. It's actually useful to understand why. So let's consider a simple example with two assets with a positive covariance, so they are payoff substitutes. Recall that when trading is centralized, the price impact is proportional to the fundamental covariance matrix. So the cross-asset price impact inherits the sign from the covariance. It is positive in the example. So for traders who are interested in taking the same position in these assets, the cross-asset price impact increases the trading cost. Now, in the same example, a negative covariance and hence a negative trading cost, negative cross-asset price impact would lower the trading costs. But the point is that these effects are absent with uncontingent trading. So even just letting assets clear independently can increase welfare in some trading environments, which one can characterize through joint conditions on the primitives. Now, a more subtle point, and perhaps the main result in this paper, is that if designed in the right way, markets with multiple venues which clear independently can be at least as efficient as the contingent market, irrespective of traders' preferences and the distribution of assets. Why? Well, this possibility has to do with the introduction of new financial products and separately the introduction of new venues for the assets that are already traded, and separately other types of innovation which would not even be well defined if trading were joined for all assets. So a broader point here is that once we dispense with the assumption that all assets clear jointly, that trading is centralized, several instruments in financial market design become available, which would either be neutral or have no analogs with centralized trading. We study these instruments in different papers. I'll try to talk about at least two. But first, let's extend the simple model with uncontingent demands in two ways to accommodate more flexible market structures and different types of innovation. Okay, so let's first permit arbitrary restrictions on demand conditioning between fully contingent and uncontingent. So now the demand for each asset can be contingent on a price vector. So traders submit demands that are contingent on the prices of the assets traded within a venue and uncontingent across venues. So the market is still described as a collection of exchanges, each for a subset of assets now. Okay, so the market still clears exchange by exchange, not necessarily asset by asset, because there are multiple assets per venue. There can be multiple assets per venue. Moreover, let's allow an asset to be traded in multiple venues. Okay, so this equivalence between equilibrium fixed point in price in schedules and a fixed point in price impacts carries over to these more general package designs, if you will, except that price impacts are now block diagonal matrices. All right, anyway, oh yeah, that was the slide I was just describing. Okay, let's consider the following example, which motivates all these ideas behind different types of innovation. Let's suppose that one of the existing assets is duplicated and a new venue, which allows traders to trade this asset, opens up to operate along with the existing venues. That's really what this notation means. That's all it means. Okay, so let's suppose that a new venue for one of the key assets opens up. When would we expect an innovation of this sort to not be neutral? Okay, intuitively, well, not in a competitive model of centralized trading. That's the classical result, which we know from our basic training, right? The introduction of assets in this whose payoffs lie in the span of the existing assets is redundant. It does not change anybody's utility. Asset diversification depends only on the asset span, but not the asset structure. Well, in practice, other than for tax-related purposes, new venues and new financial products are introduced to improve hedging, we could say, because of some form of market incompleteness, or to improve liquidity, to lower price impact. Yeah, so let's now suppose that the market is imperfectly competitive. Essentially, there's a finite number of traders, and schedules are still contingent. Well, it turns out that the spanning results continue to hold. Okay? These innovations I mentioned would still be neutral. There are many ways to show this. The quickest one is to look at the first order condition in the contingent market I set up in the beginning of the talk, where subscript plus denotes the payoff distribution following the introduction of the new venue. If we collect the terms with trade on the left-hand side and use once again that when trading is centralized, the price impact is proportional to the fundamental covariance matrix, which now is singular by construction after we introduced the same asset, after we duplicated the same asset, we see that there is a continuum of solutions, including zero trade. So even if the new asset is traded, it won't change anybody's payoffs. Okay, so let me just, do you have any questions about what is happening? We are introducing a new venue and asking when would it be not neutral? That's the interesting case. And let me actually make sure it is clear what we are doing right now. So some of you might be familiar with the results from the early competitive theory, which show that introducing assets outside the span of the traded assets would not be redundant, right? So if there is a set of estates and the existing asset structure spans a subspace, introducing assets in the complement of that subspace would not be redundant. And these results will clearly carry over to imperfectly competitive markets, centralized or decentralized. But that's not what we are doing here. We are introducing assets in the span of the traded assets. And once we acknowledge that in practice it is not the case that all assets clear jointly for all traders, the spanning results no longer hold. In particular, there are non-redundant innovations, and if introduced in the right way, they can increase welfare. So I would like to present five results, five observations about innovation in financial market design. Let's begin with the following question. Should we expect innovation such as the introduction of another venue for one of the traded assets to be non-redundant in many trading environments, or such trading environments are pretty special? Well, here's a corollary of a result I'll present later, but it is intuitive enough to be stated here. So we show that starting with the uncontingent market, so that's the realistic case, all innovations are going to be redundant. Okay? All possible venues for any assets are going to be redundant if and only if the payoffs of all assets are either perfectly correlated, in which case the inference is perfect, or independent, in which case the inference doesn't matter. Okay? More generally, new venues or new financial products will change the joint distribution of prices, price impacts, and trades. So what's the scope for introducing new venues? Can we perhaps put a number on it? Well, the intuition behind our general result can be seen in the simple example with 3 assets. Okay, let's consider a market structure with 3 exchanges, each for a pair of assets. Since all traders participate in each exchange, we can identify a venue with a subset of assets traded. Even though this market structure is comprised of multiple venues, none of which contains all assets, the outcome is the same as in a single exchange for all assets. Okay, so to see the intuition behind this example and to be able to compare the payoffs across arbitrary market structures, that's where we are going. We are interested in welfare and looking for optimal designs. Price impacts per se are not going to be useful, right? So I mentioned this result, even though the equilibrium is quite complex, we can think all we need to pay attention to is the price impact matrix. However, when we compare the equilibria across designs, these price impact matrices are of different dimensionality, they live on different assets, and they cannot be directly compared. However, price impacts per unit of asset traded, and that's all that matters for utility, can be compared usefully. So the following observation illuminates and simplifies the analysis of innovation and welfare. Let per unit price impact matrix be a K by K matrix such that the total trade of each asset across all venues is the same as it would be if these assets were traded in a single exchange, with that matrix being a price impact matrix. Okay? With that result, with that definition, I should say, we show that one can compare the equilibrium payoffs across arbitrary market structures to the single exchange counterfactual, and we can identify all non-redundant innovations with a change in that sufficient statistic. Okay, so intuitively, innovations such as new venues are non-redundant if and only if they change relative trading costs across assets. Okay, so once again, you might remember that in the competitive theory, innovations are non-redundant if they change relative prices, price levels. Here, we have an imperfectly competitive, decentralized market counterpart of that result. Innovations are non-redundant if they change relative price impacts, not prices. Price impacts, relative trading costs. Okay, back to the example. In each, so we have three venues in this market. In each venue, let's say in the exchange for assets 1 and 2, the demand for an asset depends on expected trades of the assets traded in other venues. Right? These expectations are conditioned on the prices of the assets traded in that venue. These are the contingent variables in traders' demands. So now let's look at the total demand of asset 1 traded in 2 venues in this case. Well, there are additional expected trade terms coming from the second demand. Okay, so even though in this market, no demands are conditioned on the prices of all assets, and no expectations about trades are perfect, in the total demand for asset 1, and in fact for every asset, the cross-asset inference error is eliminated. It is as if traders could condition their demands on the full price vector. Okay, so we've just answered the following question. When can markets with independent, with multiple venues which clear independently function as a decentralized market for all assets? When innovation completes traders' inference this way. Okay, so even though the market structure is comprised of multiple venues which clear independently, the equilibrium is exposed. this result also identifies a bound on the number of innovations we can introduce in markets. This result tells us that we can implement the contingent market outcome, the centralized market outcome, with simpler demands. Right? Instead of requiring that traders submit fully contingent demands, contingent on the prices of all assets, 2 assets per exchange suffice. Right? So intuitively, for this equivalence result to hold, it must be that each pair of assets is traded jointly, at least in one venue. So the bound will be equal to K times K minus 1/2. All right, we have the bound, but which innovations are not redundant? Well, not all innovations are, as it turns out. And the answer to this question underscores the role of pricing impact of imperfectly competitive behavior in this market. So it turns out that relative to, if we fix the set of exchanges, relative to markets in which traders have no price impact, or relative to the competitive markets, there is more non-redundant innovation when traders have price impact. Again, I'm going to try and convey some intuition through 2 simple examples. So let's consider a market with 3 assets with 2 venues, one for assets 1 and 2, and another venue for asset 3. Intuitively, we expect that venues that increase demand conditioning, such as the introduction of an exchange for assets 2 and 3, won't be redundant, right? They let traders to condition their demands on additional contingent variables. It turns out that this type of innovation is the only type of innovation that will be non-redundant in a competitive market. But when traders have price impact, there is more non-redundant innovation. Okay, so now let's suppose that in the original market, a new venue for asset 1 is introduced instead. Okay, so this venue does not let demands of any assets be contingent on prices of additional assets. It will be redundant in a competitive market, but it's not when traders have price impact. More specifically, we show that a new venue for asset 1 would be neutral in the original market if and only if the price impact matrix in the original market is symmetric. All right, so what does it mean? So far, I emphasized the proportionality property of price impact, but this result identifies a specific property that matters, that becomes relevant. So the asymmetry of trading costs across assets, the asymmetry of trading costs between assets, is a new property of equilibrium price impact relative to the contingent designs where price impact is tied to the covariance matrix and hence symmetric, and uncontingent demands where price impacts are diagonal. In more general designs, price impacts are going to be symmetric only under a joint symmetry restriction on the market structure and the covariance matrix. Okay, so why are these price impacts asymmetric? Because cross-asset inference are. Okay, so let's suppose that assets 1 and 2, which clear jointly and therefore involve no mutual inference effects, are asymmetrically correlated with asset 3. Let's suppose that asset 2 is independent of asset 3. Okay, then an increase in demand for asset 2 has no inference effect on the demand of asset 3. However, an increase in the demand of asset 1 will have a non-zero inference effect. So that's why these cross-asset price impacts are asymmetric now. Why is it important for understanding non-redundancy? Well, logically, for a new venue to be non-redundant, it would have to be the case that the price of asset 1 in that new venue carries different information, right? And indeed, these price impacts enter as weights on trader signals in the price function. Okay, so what are these signals? Well, in this market, traders are uncertain about the aggregate endowments, the holdings of other traders. So these are the relevant random variables in this market. And here's a slide which may not look terribly user-friendly, but this is simply the equilibrium price function, and I wanted to show you the inference coefficient, the matrix coefficient on the aggregate endowments. It is a function of price impact and its transpose, which never matter in markets with contingent designs and uncontingent designs, because both the price impact and its transpose matter. Indeed, the price of the same asset in different venues carries different information now. The price is a different linear combination of random variables. So the key takeaway from the slide is that in perfectly competitive markets, in markets with market power, there are two types of innovation. Those that let traders demand conditional prices of additional assets and therefore weaken the inference error for all assets, and those that simply redistribute the inference error across assets by endogenously giving rise to new contingent variables. Okay? This is a completely new type of non-redundant innovation relative to the standard theory. Do we still have a couple of minutes, or is it okay?
Yeah. It's no problem. You can keep going. Don't worry.
Thank you. Thank you. This is actually the cherry on top. So if you suffered through the technical part, this is the cool part about design. So what are the implications from all of this for welfare? Well, we've just argued that markets with multiple venues which clear independently can be at least as efficient as a single exchange for all assets. Right. So let's be careful here. Let's have the right perspective. As a matter of theory, this result should not really be surprising. The key question is, can we provide any results which can guide design and regulation? Let me try. Right. So this equivalence result between a single exchange and markets for multiple venues, telling us that we can implement the same outcome with simpler schedules, tells us that we can bound welfare at the corresponding contingent level, irrespective of traders' preferences and the distribution of assets and traders' endowments. And in fact, this result does not require that the policy relies on any knowledge about traders' preferences, endowments, and the distribution of assets, except for perhaps the number of assets. So it can be implemented quite easily. In fact, we show that markets with multiple venues are generally strictly more efficient than the contingent market. If once again, if designed in the right way. Okay, so this result tells us that not only are contingent demands unnecessary, but they are also weakly suboptimal. So why shouldn't exchanges allow traders to condition on prices of the assets traded in other venues? Right, it would seem that traders can condition on more information. Okay, so what is the intuition here? Well, doing so will generally increase price impact and therefore reduce the allocation. So fundamentally, where are the gains from trade, from these new designs coming from? Well, because we can compare welfare across arbitrary market structures through the single exchange counterfactual, through this price impact per unit matrix. Its diagonal and off-diagonal elements represent the trading costs of risk sharing of a given asset and the trading costs of diversification across assets. Right, so these are the costs that multi-venue trading can lower: the cost of diversification and the cost of risk sharing. Which designs are more efficient? We show that neither the fully contingent design nor the uncontingent design are generally optimal, irrespective of market characteristics. Okay, so there are two insights here. The key characteristic that matters is the joint substitutability of the asset payoff, so the covariance matrix, and traders' trading needs. So in particular, we show that even if all assets are symmetric payoff complements or substitutes, Which design is optimal depends on whether the market is one-sided, so traders are interested in buying or selling all assets, as is the case in treasury market, for example, or some assets are demanded, whereas others are supplied, as is the case in intra-dealer markets. More precisely, what matters is the heterogeneity in the joint substitution, which can favor market structures, can favor designs intermediate between fully contingent and uncontingent. So this is intuitive. Heterogeneity can make inducing asymmetric trading costs beneficial. So this tells us that regulation that promotes joint clearing for some assets, if applied in disregard of asset characteristics, can lower welfare in the Pareto sense. These results contrast sharply with those we would get if we assume that the markets were competitive, where the contingent design is always weakly most efficient, irrespective of market characteristics, irrespective of the characteristics of traders and assets. Okay, this is, do I have 2 more minutes? It's okay if you tell me I don't, I completely understand.
No, don't worry. As you didn't get questions so far, you have time, don't worry. You can keep
Thank you. I'm happy to take questions, but this is actually another really exciting problem. So let's suppose that the technology in to link market clearing across assets is not available. Okay, so all assets must clear independently. We can still ensure that multi-venue trading is superior to the contingent market for all assets by letting traders trade new products whose payoffs are defined as linear combinations of the existing assets. These are derivative products. Think ETFs, ETPs, proper derivatives, which will be redundant in the contingent model, in the standard model based on which asset pricing is defined. Right, so standard methods for derivative pricing taught in most business schools, I believe in all business schools, are based on one of the 2 following methods. One assumes the existence of a replicating portfolio. That is, it assumes that we can price new assets to be introduced in markets through linear combinations of the assets that are already traded. That is, it assumes that derivatives are redundant. Or it endows a market with an exogenously given demand for a derivative product that is then priced. But if we want to understand which financial products, which synthetic products are going to be introduced in markets as a function of the usual primitives we assume in market models, we need an equilibrium model of non-redundant derivatives. With innovation defined through payoff bundles rather than asset subsets, the framework from the previous slide defines an equilibrium model of non-redundant derivatives. So once again, a market with multiple venues can be at least as efficient as a single market for all assets. And once again, we can do strictly better, but there is a new question here. So as such, derivative products and innovation in trading technology represent alternative ways to exploit the payoff substabilities and complementarities in the assets traded. So we might wonder, can synthetic products mimic the equilibrium effects of innovation in trading technology, or for the same assets, or vice versa? Right? In fact, it seems that the design of new financial products allows for more degrees of freedom. We can design the weights with which we bundle the asset payoffs. So can innovation of synthetic products substitute for innovation in trading technology? Right, so let's make this question more precise. Given the set of traders and assets, can equilibrium in a given market structure with exchanges, in particular the traders' payoffs and liquidity, so the price impacts, be reproduced state by state by derivatives whose payoffs bundle the corresponding assets traded in each exchange? We show that this is generally not possible. even with multiple derivatives for the same assets, even with additional derivatives for other assets. And it turns out that the equilibrium property, the new property of price impacts I reported on a couple of slides ago, is again insightful here. So we show that derivatives can mimic the effects of new exchanges if and only if the price impacts are symmetric across assets. Derivatives exchanges allow inducing asymmetric cross-asset price impacts, which derivatives do not. Derivatives clear in independent venues, and they cannot give rise to asymmetries in trading costs. On the other hand, derivatives can allow for more degrees of freedom, so generally neither type of innovation dominates in welfare terms. So this result tells us that new financial products and innovation in trading technology do not substitute as innovation in financial market design. They need to be regulated separately. Okay, but if we look at welfare induced by derivatives across market environments, across different distributions of traders' holdings, it turns out that derivatives lead to a riskier distribution of asset payoffs. So a design that cannot rely on the information about traders' endowments, traders' positions, might actually favor innovation in trading technology, which gives rise to a less risky distribution of the asset of traders' welfare. Let me just conclude here. I focus on centralized versus decentralized. Clearly, markets have never been centralized, and these results suggest that this matters. These results suggest that the classical results based on spanning and the theorems which rely on them, spanning is the foundation for asset pricing, as taught until these days, do not carry over to trading environments in which assets do not clear jointly for all traders. So there's a need to develop new tools to price new financial products, new venues, new contracts, or new market structures based on game theoretic tools. Right? So to make this more precise, the spanning methods provided us with an implied representation of risk through the implied state space over which state contingent securities were defined. State contingent pricing is not useful when spanning doesn't hold. It turns out that our approach to characterizing equilibrium as a fixed point in price impacts allows us to introduce new techniques based on projected price impacts, these per unit price impacts of the fixed point problem. And these techniques can be extended to the comparative analysis of design and counterfactual analysis of changes in design across different types of innovation through the projected price impacts of the matrix representations of the corresponding fixed points. Okay, I will stop here. Thank you.
Thanks a lot, Marzena, for the great talk. If there is any questions, we have time. So,
I'm happy to take any questions. Thank you.
Okay. In the meantime, let me announce the next talk in 2 weeks. We will have the pleasure to have with us Yoon from the University of Michigan to talk about virtual teams for the gig economy. So, if you have questions, I think Marzena can take them now. You can also, of course, write her question directly by email and so on.
I have a question.
Please go ahead.
Hi, Marzena. I'm Jean Paul Rabanal. So I'm thinking that maybe your work can be applied to the ETF. As you know, ETF, some assets expand in the index and other assets are outside the index. So I'm wondering what your work can tell us more about these effects, right? Because some people say that there is this value of the index, right? So the assets are part of the ETF are going to be valued different when the assets are not part of this derivative, basically. I don't know if you can say more about this.
Absolutely. Thank you so much for this question. So in fact, this is one of the exciting insights here that ETFs and indices are not neutral. They have very different effects. And we have an equilibrium model with large traders, which can help make sense of that. So we haven't really done that, but we are hoping that people can take this model and perhaps extend it or consider, suitable versions of the model to study questions about ETFs and study the following question: which ETFs will be introduced in markets as a function of the existing asset structure, as a function of the traders' trading needs, and other primitives we usually assume when we write down market models. So there are all the other open questions in the literature. For example, we know that in practice, many derivatives and many ETFs are introduced. However, only a small fraction of them ends up being traded, and there is no theoretical research that can make sense of that. I mean, at least in a systematic way, and it is pretty apparent that you need an equilibrium model of non-redundant derivatives for that, right? Rather than working with models of based on an exogenously given demand for ETFs. And I'm hoping we haven't done it. We haven't really done it, and I'm hoping that people can use this model and tell us more about ETFs and give us predictive results about ETFs and other products that are introduced for different asset classes.
Thank you.
It is a fascinating question. I've been trying to talk to people for months at this point and get a sense of what we actually know about financial products that are introduced in markets, and we don't know a whole lot. There are these tails facts, such as the one I just mentioned, right? We know that only a small fraction of all innovations end up being traded. Others become illiquid, but we don't really know why. So again, I mean, there is scope for both theoretical work and combining these data sets that are becoming available as we speak with perhaps some theory work. So I'm really excited about this. I feel like this is a really fascinating time to be working on financial markets. An exciting time for anybody who is interested in questions about markets. There is so much to understand, given all the changes that are happening.
Any other questions?
So another way these results could be used, you might remember about a year ago when the Treasury decided to insert trillions of US dollars into the economy by purchasing bonds from the market. This was an unprecedented event, an event on a purchase on an unprecedented scale. And of course, these different bonds are cleared independently, but their payoffs are not independent. So this non-neutrality of innovation in trading technology could really be leveraged to enhance revenue in treasury markets and other types of markets, not just efficiency. I just focus on efficiency, but there are revenue implications. Suggesting that one could either tweak market clearing in these assets, or simply let traders trade additional products, which are defined as bundles, to increase the revenue for the Treasury and perhaps lower the trading costs for the traders, which was the main objective, at least as stated in this massive experiment last March. So all these questions keep me up at night.
Well, I have a follow-up question if no one is asking.
Go ahead. Thank you. No, please.
So I'm trying to understand the difference between the covariance. So you were saying that there is some difference between the positive correlations or independent draws or negative correlations across assets. So whether these innovations depend on these correlations. So your work finds any difference, or I got lost a bit in the outcome?
Yes, absolutely. Absolutely. I mean, the whole reason why you would want to think of linking market clearing across assets is that you want to exploit this interdependency in the asset payouts, right? I mean, these markets are not interesting if assets are payouts are independent. If the market were competitive, if we apply the competitive model to study these questions, well, the answer would be that the contingent design, the standard model based on which asset pricing is defined, would be optimal irrespective of the characteristics of traders and assets. But as soon as we recognize that financial markets are dominated by large institutional investors, it turns out that the characteristics of traders and assets crucially matter for determining which of these designs are optimal, right? So like I said, I mean, the conclusion that the contingent market is suboptimal is not in itself surprising, and the real question here is what can we say? Can we give any predictive results based on the characteristics of traders and assets? And having an equilibrium model allows you to do this. And perhaps a more surprising result is that even if the asset payouts are substitutes or complements, make it symmetric complements or symmetric substitutes, which design is optimal still depends on whether the market is one-sided or two-sided. So we do have these kinds of predictive results. So as you pointed out, the complementaries and substitutabilities in asset payouts. So the sign of the covariance matters even in the simplest jointly symmetric environment. But you can now develop these results as a function of the characteristics of traders and assets.
Yeah, because I'm thinking about this. So there is some experimental work that finds difference when you add these additional assets, when the covariance is positive or negative. So maybe your work can give more light on that, because they find the similar results, right? So when the covariance of the assets are positive and you add these bundle assets, they find that nothing matters. But then when the covariance is negative, right, so people find some difference, but no one can answer why. So maybe your work can answer this type of question.
Right, I'm familiar with some of these studies, but I just want to make sure I'm not missing anything. Would you mind sending me an email with the references you have in mind?
Sure, happy to.
Thank you so much.